I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, now part of Sapiens. Pick and choose your own best-of-breed insurtech and data providers with the Sapiens Advantage Go ecosystem. In insurance, we love to divide ourselves into different, mutually exclusive tribes: life and non-life, property and casualty, marine and non-marine, long and short tail, traditional balance sheet reinsurance and insurance-linked securities. And not forgetting live and legacy. But the fact is that as the global insurance ecosystem becomes more sophisticated, there are really only two major differences. There are different types of insurance skills, and there are different types of insurance capital. Legacy is a case in point. It has long since outgrown its claims administration roots into the provision of increasingly complex forms of capital relief for the live market that are bringing it closer and closer to live risk. Today's guest is the embodiment of that change. Will Bridger came into the legacy insurance world through investment banking, not claims handling. As Group CEO of Compre, he has overseen extraordinary growth with a balance sheet that has moved from the tens of millions to the low single-digit billions. If you think you already know legacy, you need to listen to Will. For example, Compre's current plans envisage only 1/3 of group activity coming from what we would think of as traditional runoff. So where are the other 2/3 going to come from? Ever closer relationships with live carriers that bring more predictable renewal-style income streams, underwriting sidecars and pre-packaged legacy arrangements with alternative capital providers are all part of the mix. This is a fascinating conversation with someone who has developed into an insurance person, as dyed in the wool and baked into the insurance ecosystem as the best of us. Will is fun to spend time with and a great communicator. 40 minutes with him and your whole perspective about the legacy market, where it's heading, and the value it might be adding to the global insurance whole will change completely. Enjoy the podcast. Will, welcome to the Voice of Insurance.
Thank you. Great to be here.
For anyone out there who's listening who doesn't know you, can you just run us through your career? Well, why don't you start with the thing we always start telling each other when we first meet in insurance is we tell each other how we got into insurance in the first place.
And like a lot of people, I kind of fell into insurance. I started my career in investment banking, actually not far away from here at 41 Tower Hill with a traditional bank called Hambros. And I started on the Eastern European team, would you believe it? I had a master's in Soviet studies. It was 93. The wall had been down for a few years. And like a young enthusiast, I was passionate about a new region opening up. I was passionate about making an impact. So I spent the first 2-3 years working on projects in Siberia, Czech Republic, Poland, et cetera, et cetera. And then, like a lot of organizations, strategy changed. And I suddenly found the Eastern European team was getting smaller and smaller. And so I looked across to the other side of the room and went, what do you guys do over there? Oh, well, we're the insurance team. I said, great, can I come and join you? And that was it.
Hambro is still involved in the insurance industry in different ways?
Yeah, I mean,
some pieces.
So Hambros got bought by SocGen. SocGen expanded with the internet bubble, then contracted. And I found myself moving on, as we do. All of us, I think, at some point in our career, either move on because we're looking for a new challenge or because somebody else makes that decision. In this case, it was a corporate decision from France. And I'd spent 4 or 5 years at Hambros, SocGen, SG Hambros. I cut my teeth with Guardian Royal Exchange. I did lots of stuff with them.
This is late 90s now, is it?
This is, late 90s, 96 to 99. James Morley was CFO at Guardian Royal Exchange, had a really good relationship. They were a retained client at Hambros. And I spent a lot of time talking about strategy, market position, what were they looking to try and do in the market. I didn't get involved in transactions early on at Hambros. I became a sector specialist. And so the investment banking environment for me was really interesting. I really delved in, particularly UK, but also Northern Europe. And then, as I said, SocGen kind of started to restructure. And around about this time, I got married, first child on the way. And I was offered an opportunity to go to Paris and work with SocGen. And my wife, who grew up in Montreal, said, no way I'm going to Paris with a brand new baby staying in London. So I joined PwC, corporate finance, mid-market, M&A, and suddenly I came across this wonderful world of runoff, Dan Schwartzman. And while I was there, he introduced me to a gentleman that was running a legacy business. He was a Finn. And Dan said to me, Will, you know about raising capital, you know about transactions. Can you meet this buddy of mine, Mikko Sinko? He's looking to raise 20 million euros. Mikko was the founder of Compre.
Right.
So I found myself morphing in from investment banking into professional services firm, doing mid-market transactions. And then suddenly I came across this wonderful world of runoff. And I met Mikko Sinko, the founder of Compre, back in 2004.
And he was actually in the process of founding Compre, or was it already?
No, Compre was founded in 1991.
So it was a live
APH.
underwriter then?
It was a live underwriter.
Right.
Well, Compre wasn't. It was a business called Fig Re. It was owned by a Finnish group called Industrial Mutual. They were struggling with big losses. Mikko came over to the UK to look at it, do a strategic review, put it into runoff. And then he formed Compre as a service business for Fig Re. And this is early 90s. And Compre stayed as a service business for 10 years, just managing the day-to-day settlement of claims for this business called Fig Re. And then in 2004, when I was at PwC, they were looking to acquire their first companies in runoff.
Because by that point, you'd pretty much run off Fig Re, or there's probably a few little things left, but not much left.
Yeah, in part. But actually, you'd be surprised. There was a lot more to flow. There always was with asbestos. But the team started to be a little bit more ambitious. They wanted to take on more liabilities. And so they needed capital to do that. And that's where I came in.
And so what sort of scales Compre got to these days? What sort of balance sheet size are we talking now? And how many people?
When I got involved in 2010, we did our buyout. So 2004 to 2010, kind of independent investors alongside, still small business. We were about 50 million of total assets in 2010. We're about 2.7, 2.6, somewhere around that billion assets now. 700 million of net tangible assets. We were about 20 in 2010. Super support from investors all the way through, but financially, it's been a spectacular growth story over that period of time. People-wise, we were about 30 people in 2010. We're now about 200.
So when you're sitting in a marketing meeting and you're trying to attract people to Compre, what's the end result that you want? If there's a broker or somebody out there, a carrier out there, wandering up and down Lime Street, when I say the word Compre to them, what do you want them to think? What would be your ideal outcome to say, oh, these guys, they're great on this?
So I think over the years, what's really stuck for me at Compre's capabilities is creativity, complexity, innovation. I think we stand ourselves out at finding a solution for our clients. Legacy is not simple. If we had the easiest and the best books of business coming our way, most of them wouldn't be discontinued and in runoff. Our market has evolved enormously. So we always get the difficult stuff from the insurance and reinsurance market.
Yeah, it couldn't be any other way, could it?
No, exactly. So inevitably, you have to sit there and say, what is our client trying to achieve? How does that fit for us, both in terms of our capability and in terms of our economic return that we're looking for? I'd love to think that most people would sit there and say, we trust them, they're open, they're honest, they're transparent, and they're really good at finding solutions to complex problems. That, for me, kind of is the ethos of what we do here at Compre.
Run us through the state of the legacy market. Obviously, the great things about the legacy market, the runoff market, is that it operates in a cycle that is independent from the live market most of the time. Obviously, everything's driven by capital. This is a capital-driven industry. Capital is abundant. Sometimes it's scarce. Everyone has cycles. But where are you at the moment in the runoff world?
So I think we're coming out of the hard market, which has not been great for the legacy market. Volumes have been down. When the tide is in, people don't really look at what's on the seabed.
Well, they're too busy making money, aren't they?
Exactly. And they're all focused on growth, as you'd expect, as opposed to other areas where they can tighten their belt, they can tighten operations and really enhance ROE. When the tide goes out, you suddenly start to see what's left there. So I think we're on the cusp of that. We've certainly seen an uptick in volume of activity this year. But if I go back to 25 and 24, volumes are down, both in terms of numbers of deals and in terms of value of deals. The legacy market, the retrospective market, call it what you want, is typified by, and has been typified by, one-off deals. That makes predictions, forecasts really hard.
Because it's just a big lumpy thing. Sometimes there's deals and there isn't. So you can't really compare one year to the other.
You can't. And then it's binary. You either win or you lose. And if you lose, you get 0. If you win, you get 100%. We'd love to share a little bit more, but I just don't see that coming. And so compared to the live market, and Lloyd's in particular as a subscription market,
it would make a ton of sense, wouldn't it? I mean, especially now you've actually got enough of you with a Lloyd's platform that you could syndicate runoff, couldn't you?
Absolutely.
But that's just not happening at the moment, I mean.
No, and typically we were claims-led businesses. And as a consequence, you want to have claims control because you believe your claims expertise is going to make a difference to the ultimate outcome.
I suppose, yes, so there would have to be a lead, and they would have to be the lead of that. Well, you could have a consortium, but you would really have to trust that lead to know that, yeah, they can do just as good a job as we can.
For sure. But also, increasingly, cedents are retaining claims control. The more cedents seek to retain claims control, the more we get comfortable with claims influence, certain requirements that we have when we put them into our administrative agreements where we want to be consulted on certain developments. I think the more we get comfortable with that as a market, the more easy it is to syndicate.
So you become much more of an allocator of capital, really. You're allocating risk capital and you're trusting that cedent's claims handling ability.
Totally and utterly. And if I look back over the last couple of years, I think the traditional legacy group where all you were doing was acquiring and managing your own business for your own account, where you were driving claims activity. There's an element of that in our model, but it used to be 100%. Going forward, I expect it to be about a third of what we do. So it's changed enormously.
But you still have to employ those experts, particularly, of course, in the legacy world, you end up becoming the only ones who know how to deal with mesothelioma claims because you're the ones with any of that on your books these days.
Yeah, you do. And there's a lot of that. But there's also TPAs that are particularly good at managing certain classes of business. I would say increasingly legacy organizations need to focus on what they're really good at from a claims perspective, and then have a really strong TPA management model. Yeah. We cannot manage every line of business.
If you're good at managing TPA, by the way, obviously a third-party administrator, if you're brilliant at managing, you know which TPAs are the really good ones and you're really on top of them and you're really happy with them, then that could easily be the best way of doing it. Totally. If they're the only ones who really, really know about these old certain specifics.
And particularly in Europe where we're very strong, you can't have a claims team in Germany, France, Italy, Spain.
It's not going to be efficient, is it?
It's just not, no. Particularly as you start to run off books of business, you then get down to a rump. Having a TPA model that you are super confident with and great relationships with, I think is key.
So the more traditional, what we'd associate with the traditional runoff legacy world, that's only going to be a third of the business. So what are the other 2/3?
So last year, we spread our wings. We decided last year that actually our business was really all about deploying capital for the right return. And we had a core set of expertise that as we were being asked to underwrite more recent underwriting years, the greener years, anywhere from 24, 23 underwriting years, we realized that actually we had a degree of expertise in pricing the current year.
I suppose if you've spent 20 years cleaning up after people, you have a pretty interesting amount of data, particularly about how things can go wrong, but also you really understand what that ultimate net loss ratio is likely to be. You may well understand that better than some of the live underwriters.
Well, it's interesting because from a reinsurance perspective, when you get the submission data from a broker, it's focused very much on premium, loss ratios, but not so much around claim development, claims management. How is the cedent making a difference to the ultimate claims cost, which inevitably drives your value? So the diligence work that we were doing with clients and the relationship we were building with clients, we realized actually positioned us really well to take the more recent year. Not in a big way in shape and form, but it was very complementary. And not just that, the relationship that we were building with the client was sitting there saying, well, you get to know our business really well. How else can you help us in managing our capital more efficiently? So last year, we underwrote a number of adverse development covers, and in particular in Europe on a cancel and replace. So these are transactions for a single year, and at the end of the 12 months, the cover gets cancelled and gets replaced by the most recent underwriting year and prior. So we're building in a renewable structure, recurring flow in our transactions. And we also underwrote a whole account quota share for a US specialty carrier that we'd spent a lot of time working with. We'd worked on a combined cover. They didn't buy the reserve cover, but they bought a quota share. And we were really well placed as a collateralized market to sit alongside the rated community because we knew their business so well. And it worked really well.
So these days, it's much more about capital allocation, and this is repeat business, which is going to make your results look a lot smoother these days because there's less of that feast or famine type business. So 2/3 of your business is likely to be on repeat business, also supporting new live business.
Yeah, that's the objective for us.
So the sort of structure is if almost you've institutionalized, in year 3, we take this over. Every third year we take it over, a bit like in Lloyd's, we reinsure you to close every time.
Exactly.
And we get very comfortable with this, and of course, and you get more and more comfortable with me. And it's more efficient that way. Presumably it's more efficient because your capital structure suits squeezing that last bit out of the lemon.
Yeah.
And the live underwriter is far better for getting that first stuff in year 1, year 2. And if they can take their profit immediately in year 3, that's pretty handy for them.
And it does. It allows them to recycle capital. So the objective is to drive the IRR for investors. Equally, I think what it does is the closer we get to our cedents underwriting, the better we're able to price it. In a traditional legacy deal, we'll get a short period of time to review a book of business and set a loss pick. Inevitably, the information asymmetry as a result of that pushes us to be more cautious. If we are alongside on either a recurring ADC or we're there on the prospective, in some shape and form alongside other investors, we're able to align over time. And that means that we get more comfortable with the risk that's being written. We get more comfortable with the management processes, the underwriting guidelines, the claims approach, and the reserving philosophy. All of that goes to a better price, means that we have a flow of business coming into our organization. It reduces the uncertainty to income for us, and it brings us closer to our clients, all of which inevitably is good and positive.
That's also easier to syndicate, isn't it? Because if they've got the claims control, that scene, you can all collectively make that decision that we all support this underwriter, that we know they're pretty good.
Yeah, totally.
Yeah. So again, you can then come in with different shares. Again, it manages your own risk. Yep. So you don't have to bet the farm on everything. Yep. These big deals and these big lumpy deals that if they go wrong could put you in jeopardy.
Absolutely.
So in terms of the split of that 2/3, how much is likely to be the live underwriting, the sort of collateralized support, sidecar type stuff that you were mentioning, and how much is likely to be the institutionalized adverse development cover? But that was another one of those 3-letter abbreviations. ADC, you managed to slip that one in. Adverse development covers, or the kind of where you become a long-term partner of a live underwriter and say, yeah, I'm your year 3, take it all away kind of market, and allow them to recycle that capital into their new underwriting year. What's the split, do you think, is going to be of those more novel forms of underwriting? Yeah,
I think ultimately we have an objective to build our prospective book up to around about 1/3 of our overall profit in any one year. We're new into the marketplace in Q4 25. We'll grow it carefully. We all know there's every opportunity to put volume on a balance sheet in the reinsurance market, and it's just a function of price. We've always been a fairly disciplined organization from a pricing perspective. We're taking new risk in the marketplace, so we'll do it carefully. I think there's every ability for us to, though, grow a business and a portfolio of 400-500 million of gross written premium over the next 3-4 years.
But you've built a platform that is everywhere it needs to be, London, Bermuda, etc., US. Where are you seeing the best opportunities? Where are you happiest at the moment in terms of the quality of the inquiries that you're fielding?
So I think the US for us is still the biggest marketplace with significant opportunity. But I think it comes in pockets. And there are so many market participants, commentators around casualty development, social inflation. I won't go over those things, but Social inflation, clearly nothing new in the marketplace, but still impacting. And broad claims inflation has challenges for particular classes of business. But I think commercial auto, workers' comp, GL will continue to be markets where we find opportunity. The question is, what's the adequacy of reserves? And I think we see it across the marketplace. You've got conservative reserve balance sheets and you've got not quite so conservative reserve balance sheets. We see opportunities in the mutual sector, particularly with this principle of a more holistic capital solution where we can provide a reserve cover alongside a quota share, a combined cover. I think that works really well for mutuals.
Yeah, because of course, I mean, they don't have such flexible capital. In that sense, they can't issue new equity or whatever.
Exactly.
So if you can give them capital relief, they can really feel the benefit of that, can't they?
And what we want to do is to build those longer term partnerships. And that can be with a monoline carrier. And again, we look to the quality of the team, we look to the quality of the reserving philosophy, we look to the quality of the claims handling. Those for us are really important in the context of building that relationship, which can be a 4 or 5 year relationship for us comfortably.
But in general, you're finding there is enough in the particular US casualty world that you're comfortable with. And obviously, given your 30-year experience in knowing what good looks like in casualty, this is obviously a good sign that you see enough rate and reserving adequacy there.
I think there is. But as I said, again, you've got to pick and choose where you play. We all know that. I think Europe has always been a really strong market for us. That continues to be the case. Years ago, people looked to Solvency II for an explosion in activity in our market.
There was the great hope for many people.
There was the great hope, which never materialized. If I go back years, certainly 10, 12 years ago, more than that slightly now, we bought a business in Switzerland. The intention was that this was going to be a platform for growth in the Swiss market. And we only ever did one deal in Switzerland. Now, I think Europe has always been cautious and conservative. I think, though, I see the kind of Europe in two things. You'll still get the traditional legacy, the discontinued book of business. But equally, as more private capitals come into European carriers, you're getting the capital optimization deals come through. And obviously, we did a deal with Wacom, which was announced towards the end of last year. That's a good example of the kind of shift in development at the European market.
Obviously, there's La Parisienne is sort of at the bottom of all that, which is hundreds of years old.
Yeah.
But it's fascinating. I did have actually the UK CEO of Wacom on. But again, in terms of that's bringing very modern thinking to a very traditional insurer.
Exactly. And it's how we can combine with that kind of organization where we can bring a broader diversified balance sheet to play under Solvency II and give them the kind of capital relief they're looking for on a recurring basis. Works well for them and us.
But if they're retaining claims control, under an arrangement with you, that's the ultimate comfort, isn't it? So we can pay. Absolutely. If we're worried about our reputation, we don't need to worry anymore. We can pay. And that must be the final sort of key to open the door to some of those people who said, well,
absolutely.
They'd assume it wasn't for them. And now they can think, well, actually, I really can entertain this.
Yeah.
So live market is softening almost all over the place. Either it's about to soften or it already has. How does that affect the interaction between you? Obviously, it's quite interesting now that your feet are in both camps at the same time. Obviously, you mentioned before, no one's really interested in deals because they're too busy, all hands to the pump, trying to grow the business. If you doubled or tripled the price of what you were selling, then yeah, perfectly fair enough.
Yep.
And this is the most optimal thing we can do right now. Of course, now that foot's come off the gas, managers are going to be looking at their portfolios and thinking, right, which bits don't necessarily make any sense anymore. Presumably it's a boon for you because they're going to have more conversations. Well, this stuff that was really optimal a couple of years ago is now becoming suboptimal. And can we, optimize our capital around that?
Yeah, totally. I did see a fundamental shift where clients are going to sit there and say, a line of business that was optimal is now suddenly suboptimal. I think it's in the hard markets, portfolios that are marginal just don't get attention because they don't need to. And in the soft market, they suddenly become a little bit more urgent and a little bit more drive. The actuaries are looking at how much capital is being tied up in certain lines of business. Do we get the right rate? What's the loss development? And fundamentally, they're sitting there saying, is the return on capital by line of business and geography, Is it hitting where we need it to be? And then the second question is, strategically, do we need to be in that marketplace or not? So I think the soft cycle brings more rigor and more discipline around that capital allocation.
Yeah.
And as a consequence, we see more activity. And as you said, going forward, we're going to have a foot in both camps. And I like the fact that we're going to have a foot in both camps, because for the first time, we're going to be able to look at our underwriting across the market and say, where do we get the best return for the capital we're going to deploy? Historically, we've only deployed capital in the legacy market. And therefore, we've been at the vagary of the boom bust of, will we win the deal, won't we win the deal? Now we'll be able to choose based on the price for our capital in both sides. And going forward, we'll be able to manage that counter-cyclical challenge way better than we've ever been able to do before, with more certainty to income, and more certainty to business flow.
It makes absolute sense. But I suppose, would it always be casualty first, because that's where we know you to play, where you have that expertise? We're not going to suddenly see you get into some, short tail. I don't know. I mean, obviously, it might make sense from a capital point of view, because obviously diversification is good.
You're absolutely right. And it is all about diversification. So the Series Point deal we did in 2023, we took on a large percentage of property cat, but it was mature property cat. It's the last top-end development of any event, and we're still managing some of those events out.
Once the event's already happened, it becomes more casualty-like, doesn't it? At that point, it's managing claims and
it is,
hoping it doesn't hit X number.
And, a number of us have looked at the kind of trapped capital solutions for the ILS market. I think there's a few of us have executed deals. But again, in a benign property cat environment, ILS managers are not overly interested in putting tail solutions in because they don't have a lot of trapped capital. But I think for all of us, and particularly certainly at Compre, balancing the portfolio geographically by line of business, prospective versus retrospective, it's all about a balance to the risk on our books.
So nothing's really off the table necessarily.
It's interesting because if I think about our risk appetite and I look at our risk appetite statement that we present to the board every year and the regulator, there's very little that's green, there's very little that's red, and there's this vast swathe of amber, which for the right price. Right? And so I guess what worries me a little bit with that, Mark, is jack of all trades, master of none. And when I talk about wanting to be able to deploy capital for the right price, you've really got to understand the risks that you're taking on. So there are certain classes of business on the casualty side where I would say we are experts. We have real centers of excellence. Like med-mal is one of those in Europe, unusually so. And it's a complex line of business, and it plays really well to our complexity, the capability we have of our claims team. So even though nothing's really off the table, we still want to come back to what are we really good at as a business and what are our teams really competent at?
Yeah, it's really interesting. That kind of the traffic light, the red and the green, you've got high tide and low tide, and you can run around. There's quite a lot of space in between, isn't there? But as long as you don't get wet, it's fine.
Key is to keep your feet dry.
Yes, and it's interesting. I would like to ask you more detail about those casualty sidecars. This seems to have become a feature now. When I'm reading financial statements of some very big carriers, and ones obviously they're pretty big in casualty globally, starting to get these away. Do you think it's going to become a much bigger feature? It seems as if often with these things, once 2 or 3 people have got them, then everybody else wants them, because if it genuinely does work and it is a more optimal way of deploying capital, improves their returns and gives you an opportunity that you're happy with, then there's no reason why it shouldn't. Do you think it's going to become a growth line, the sort of thing that we think, well, actually all the top 20 carriers in the world are going to end up with one of these?
Yeah, I think there's a good possibility of it. I don't see it as being the latest shiny new toy, that's for sure. I think there's a real interest in deploying more capital into the casualty markets, and that capital is coming from lots of different places. But if you can bring capital in that needs an exit, wants to have an exit and a defined lifespan, I think you can attract more sources of capital to the insurance sector, which I think is good, certainly on the casualty side. I think there are challenges around forward exit because you're being asked day one to price an event in anywhere between 5 and 7 or even 10 years' time. And it comes down to the quality of the data, the underwriting guidelines. Where is that book of business going to be? What's the interest rate environment going to be like in 5 years' time? Clearly difficult to predict. So I think there's some really interesting elements of it. And we partnered with two investors at the end of last year and QBE Re. So the investors were Calidris and Culpeper and the George Street Re sidecar. We've known QBE for many years. A number of our team here are ex-QBE. So really strong relationships. And we liked the underwriting. We've known Calidris for a long time. Culpeper, we were less of a strong relationship. But so when you come together to bring new capital to bear for an organization like that, it gives them an opportunity not just to fuel growth, which is in part important, but it gives them an opportunity to switch underwriting risk for fee income. And I think going forward, we're going to see more and more of that. We've seen a lot of it already. There's plenty of organizations in the reinsurance market who've got lots of different sidecars. Sidecar structures are not new. There's plenty of casualty sidecars with ultimately a commutation back to the cedent. Cedent doesn't always necessarily want to take the risk back onto its balance sheet. And in the MGA market, actually, the MGA doesn't want to take or hasn't got the capability to take it back. Maybe the front doesn't want to take it back. So I think this is about opening up access to a new capital base, private capital, private credit that's looking for a return.
It's quite interesting, but you've got that full service potentiality at the end of this thing. You've got the people who only want to be in for 4 or 5 years, and they've got their certainty that they can leave. And then, of course, by the time, of course, that's been sweated down, it'll become much smaller, those liabilities.
Correct,
you can probably take them away, couldn't you? Your more traditional run-off
And that's
solution.
exactly what we're doing. Yeah.
Makes a ton of sense because you could be in at the beginning and move on.
And there are certain books of business where actually we probably want to be just on the back end. Perhaps there's a little bit more uncertainty on the underwriting. And there's definitely portfolios where we want to be on the prospective. And so the QBE Re book, we took a small share of the sidecar. And there'll be other portfolios where we also want to take a 5-10% line on it. This is not about Compre leading the underwriting. It's about us participating as an aligned partner with others.
And also, yes, when you have that full alignment, it's not always this kind of heads I win, tails you lose, or that one of you has to lose somehow, zero-sum game.
Absolutely.
It shouldn't necessarily be that way. You should all be partnering, and hopefully you all win a reasonable amount together.
Yeah. And if you look back over the years, I think there's definitely been winners and losers on the legacy side. And the ultimate objective on any transaction, whether it be prospective or retrospective, is actually both parties really gain from the transaction.
Yeah, but also in insurance and reinsurance, you think you're winning, but then if you find the cheapest reinsurer in the world and everybody buys tons of cheap reinsurance for the cheapest reinsurer in the world because they're not as good at assessing risk as everybody else, well, but who's the fool? Ultimately, they go bust, and
exactly.
You were all fools for having bought reinsurance off someone who was a fool. So who is the fool?
Yeah.
You do want to deal with people who do know what they're doing because you want them to be there when you actually need them. Ultimately, I mean, that's the slightly boring version of insurance, is that you all have to win, otherwise you can all lose in unexpected ways.
Totally.
And you think you're winning, but actually it's not winning, is it?
Yeah, agreed. Yeah.
What about the prospects for consolidation within runoff itself? Obviously, you do inorganic growth all the time because obviously this is the mechanism by which you often acquire books of business in runoff. So obviously you can do deals, and obviously you're a deal maker. You're an investment banker by trade. Yeah. This is how you came into this industry. Do you think there's prospects for consolidation within the legacy world? Legacy on legacy?
Yeah, it's interesting, isn't it?
It's never really happened.
It hasn't happened, except out of distress. So Armour was the first one that got into a little bit of difficulty, backed by Aqualine, bailed out by Premier, and obviously the R&Q challenges more recently. So we've seen some transaction activity, but it's an interesting environment. I would have said that the hard market put the spotlight on the robustness and resilience of our operating model, the hard live market, because deal flow didn't totally dry up, but deal flow dropped to $5.5 billion a year from 8, and we were all expecting it to rise from 8 to 10 and beyond. So really, the addressable market for legacy is very significant, but in the hard live market, just didn't materialize. So that kind of really puts the spotlight on your organization.
And again, this becomes a structural problem for the whole legacy sector.
Totally.
If you thought, you were capitalized for X and it ends up being X minus about 40%, and no one really knows why. And then you're suddenly really overcapitalized and it can become incredibly competitive, and everyone's complaining about none of these deals make any economic sense, but kind of I've sort of got to do them.
I mean, the capital position doesn't worry me so much because inevitably you can return capital back to shareholders. It's the cost environment. And to be fair, what we've done at Compre is we built a business for scale. And then you have to have the volume of activity coming through in order to be able to justify that scale. And I think it's public record, we had a tough 2024. We had a great 25, rebounced back into the marketplace, diversified our product set, and not just within retrospective and prospective. In prospective, we underwrote 3 different types of different products. So I think we recognize the challenge of an increasing cost base with volumes dropping, and we decided to move in a slightly different direction. You've got Enstar, the biggest in the marketplace, just bought the accident fund. Are they heading back into a prospective environment? They've been there before, perhaps not so successfully, but workers' comp is a core proposition to them. You've got Riverstone, half the size. We're half the size of Riverstone, roughly. And then I think that mid-market area, you've got a lot of costs in these organizations.
So it sounds like you're talking yourself into something. Well, I don't know.
Is there an inevitability to it? Time will tell. But I think what we need to do as leaders of our organizations is make sure we have a robust long-term market. We are resilient through the cycles. And if that results in businesses coming together because it's the right thing for the market, then I'd be a big supporter of that. I'm not expecting it though, Mark, anytime soon.
What about your own capital? You've got Cinven, BCI. How should we view them? People always say, oh, my capital's far more permanent than all these other transient capital everyone else has got. It's partly your job to say that, of course, your capital is incredibly evergreen and will never want to exit. But I don't know, how should we view it?
So BCI, British Columbia Investments, perpetual capital in the form of Canadian pension funds. We've seen CPPIB, CDPQ, and others.
I think we should be eternally, as an industry,
we should be eternally grateful.
How much
the
of the industry is capitalized by Canadian pension funds?
A lot of it. And obviously AIMCO are in Fortitude as well. So across the board, the Canadian pension funds have been super good at investing in the insurance industry. They recognize the uncorrelated nature. They've had experts to be able to get their arms around the risk.
To be fair, they've done well out of it.
They have done well. And look at Ontario Teachers. And Philippe Trahan moved on from there to found Calidris with Dan Miller from Blackstone. Some really interesting organizations, but founded from originally the Canadian pension funds. So for us, BCI are a super strong partner in every shape and form. And they sit alongside Cinven, they sit pari passu. BCI have invested with Cinven. They've been as a LP of Cinven's for decades, so they know each other super well. And we sit with Cinven in their strategic financials fund. The SFF is a 15-year fund, and we were in year 1, which is 5 years ago. So
there might be a clock ticking, but you can't hear it.
I can't hear it at all. Having said that, this is our third set of private equity financial investors. We have a great relationship with them, but all great relationships come to an end. They're private equity. They will, at some point, want
they can't
an
just
exit.
look at bits of paper saying how well they've done. They have to actually get some cash.
Exactly. So that'll come at some point in time. No pressure. The traditional pressure on performance is always there. Personally, I love the discipline of private equity. I think it makes you a better business. There's more rigor. There's more
nowhere
focus.
to hide, really, is there?
I can tell you as CEO, there's definitely nowhere to hide. But it does make you focus on what is important in a business and the discipline, the transparency. And actually, I've really valued that over the years. And equally, from the other side, all investors need a management team. And they want a quality management team as best you possibly can. So things like succession planning in our business, leadership and development, super important. I remember the times at Compre when we maybe spent $5,000 or $10,000 a year on training, and it was technical training. We now spend $500,000 to $600,000 a year on leadership development, people development. So it's been a huge transition for us in that regard, and it's super, super important for us. The quality of the team, that's what private equity looked at.
I mean, everything's moving on. Now I'm going to ask you about AI, because in the last couple of years it's developed to being something we all must talk about. There must be so many good applications for AI within the legacy space. So which ones have you found most useful so far?
So it's interesting. My guess is everybody's looking at it in our sector.
I think within claims, there's got to be so many excellent potential applications.
It is. And I think it's hugely exciting. What do I think it can do for us ultimately? And my focus is on two things. One is on risk mitigation, and the other is on efficiency. We're around 200 people managing 1.5 billion of liabilities. We've got 45,000 claims. If we can settle those claims quicker with less cost, and I'm not thinking indemnity, I'm thinking allocated loss adjustment expense, the speed at which we can get indemnity to policyholders, if we can do that more efficiently, we should be doing it. That's our job. Our job is to pay the last claim. So there's a lot of focus around efficiency. Equally, I look at our monthly reporting and I think, well, actually, my quarterly board report is a function of my 3 monthly reports. Why can't I have an agentic tool that does that automatically for me? At least 70% of it. So that's definitely a challenge for my CFO. The real area that I think can drive ROE, I think efficiency will help. It's not going to take our cost base and cut it in half in 18 months' time. It's not. I think where it can make a real difference is on the risk that we're taking on. So we're in the process of building a proprietary claims intelligence tool. We'll have an MVP probably September time this year. We've got a couple of AI partners that we work with who are super great. And I'm really excited about the prospect of really starting to be able to understand the risk early. And it's partly about kind of informing ourselves as to what the dangers are in our existing book of business, but just as much it's about the future.
So having an AI that says, right, we should escalate this one pretty quick, because I know that we've seen that this kind of thing can explode if you don't move quickly, or that kind of thing.
Yeah.
Or someone who's distilling 30, 40 years experience of some of the most senior claims handlers and, deploying that knowledge at scale across the portfolio and say, you know what, we've seen those before. And okay, they don't all blow up, but if you don't get on top of them, one of them will, and it'll be, instead of being hundreds of thousands, it's going to be millions. Correct. Before you know it. And so therefore, almost sort of triaging your claims portfolio to say, right, guys, these are these 10 I know you really need to look at.
Correct.
Because, maybe a couple of them are red herrings, false flags, but I tell you what, we only need one of these to blow up.
Exactly.
And we will
but
really
if it turns out to be a false flag, that's a good thing.
Yeah, exactly.
There's two aspects for me. One is when we're doing a transaction, there's massive information asymmetry. The cedent always knows more about the book business than we do. Now, that didn't used to be the case. When I first started in 2010, we were...
sometimes the reason why the thing's in runoff because no one knew anything about it.
Exactly.
They should never have got into it in the first place.
They shouldn't have got into it in the first place. They've stuck it in the basement. Nobody knows what's in the basement. We used to love going into the basement of lots of European insurers and filching around saying, what's good in here? And then we'd be able to negotiate because we knew more than the counterparty. When you're looking at transactions with portfolios that are materially 2020 to 2024.
Well, certainly there was an element of also all of you guys were so good at recovering defunct reinsurance.
Yeah.
Partly because often there was things you were already running off anyway.
Absolutely.
Because if they've still got some fig re on there, we know
what it
your
is.
quid's in.
So that kind of environment's shifted. Now, we'll occasionally find the odd deal that is in that vein, but it's really rare. So with the information asymmetry and a sample set, so pre-AI, we'd be able to go and review a sample set of 3,000 claims in a portfolio. We might be able to look at 100 of them, but you'd never look at all of them until AI gives you ability to look at and focus on particularly unstructured data and get way more insights on a 3,000, 4,000 claim file. What do we really need to look at? What are the dangerous ones? But they might be reserved at $50,000 or $60,000. But if there's a risk of it going to 500, that's where you get your big deterioration. If you get 10 or 15 of those shifting and you haven't seen it, then you're going to get a material deterioration. So this tool that we're building is designed to give us much more visibility on the difficult claims in any particular book.
And I suppose also it just gives you that volume. You have the ability to look at more deals.
Yeah.
Because I suppose in olden times, pre-AI times, there's only a certain amount of capacity you have to look at a deal because you only have so many people who can look at it.
And there are simple efficiencies that you can bring to bear with agentic AI, Copilot, recording diligence conversations, getting Copilot to cross-reference. What have you heard from a management team discussion against the VDR? Does the VDR virtual data room. Does the data room evidence that you're being given by a counterparty, does it stack up with what they're saying? You can get an AI tool very simply to do that. 75% of that work in minutes, which is great. It's a great place to be. So all of this, I'm super excited about the development. As I said, the real shift in impact on our ROE is going to be around risk rather than cost efficiency.
That's really good. So it's the really good stuff because it's skill rather than just, basic efficiency.
Yeah.
Well, I've come to the end of all my questions. I've really enjoyed chatting with you. As a broker in 1992, my first encounter with runoff would be, going into this sort of, a very dusty office with a retired underwriter, should we say, who was sort of eking out this existence until he could collect his pension, I think. There literally were stacks of paper, and it really was quite dusty and sort of musty, like old Latin book sort of smell. Yep. And the industry's completely transformed these days. There's nothing like that anymore back in those early 90s days of the sort of figures, etc. Yeah. So thanks very much for coming on the show and for bringing me up to date. It's really interesting.
Great. Thank you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.